There has been an unwritten rule on Wall Street for the past 40 years. Silence on a Friday evening usually signifies settlement. Positions have been closed, risks have been hedged, and the bankers have left their offices to enjoy the weekend. But this weekend, that silence carries a completely different tone. It is the calm before a Category 5 storm. Last Friday, we witnessed a technical black swan event. According to the standard script, silver prices are always subjected to automated selling pressure during the final session of the week to crush the momentum of the bulls. But this time, that script was torn to shreds. Instead of collapsing, the market accelerated and closed at the absolute highs of the week, $67.14. Let that number sink into your trading psychology, 67.14. For the retail investor, this is good news, but for the risk management departments at the major bullion banks, this is a liquidity disaster. They are currently trapped with billions of dollars in net short positions that are deeply underwater while the market is closed. They are locked in a panic room with no exit for 48 hours. In today's deep dive report, we are going to dissect this event. We will analyze why this closing price is not just a number, but the fuse that will trigger a massive chain of margin calls come Monday morning. To understand the severity of this, we need to look at the market microstructure. When a market closes at the highs of the week, it sends an incredibly powerful signal. The buyers accepted market orders at any price, right down to the final seconds. This indicates that smart money currently fears the risk of not owning the asset more than they fear the price risk itself. Put yourself in the shoes of a market maker who is short silver in the $64 region. Their quantitative models predicted a drop to $60 so they could cover and take profit. But reality forced the price to $67.14. Their unrealized loss is currently sitting at over $3 per ounce on a volume of millions of ounces. But we must also address the elephant in the room, the options market and gamma exposure. At $67.14, we have pushed deep in the money, ITM, for a vast array of call options that were previously written off as worthless. This forces options dealers into a gamma squeeze. As the price rises, dealers, who must remain market neutral, are mathematically forced to buy more of the underlying futures to hedge their exposure. It becomes a feedback loop from hell for the shorts. They aren't just fighting the trend, they are fighting the mathematics of the derivatives market itself. Furthermore, we must anticipate the reaction of high-frequency trading algorithms. These black boxes thrive on momentum ignition. A gap opening above $67.14 will trigger automated buy programs before a single human trader has had their morning coffee. These algorithms do not care about valuation, they only care about velocity. They will pour fuel on the fire, exacerbating the move in milliseconds. And here is the fatal issue: variation margin. Typically, these losses are settled in cash at the end of the day, but Friday's price shock was too massive and too fast. It blew through the credit lines of many hedge funds. On Saturday morning, while the market was closed, margin calls were sent out. The demand is simple: post additional collateral before the Asian Open on Monday or face forced liquidation. And when a short fund faces forced liquidation, the computer system executes only one command: buy back at any price to close the position. This creates a classic short squeeze scenario. On Monday morning, we may not see buying power from natural demand, but buying power born from the panic of financial institutions trampling over each other to exit. However, the financial story is just the tip of the iceberg. The submerged part, and the most dangerous part, lies in the dislocation between the paper market and the physical market. We are witnessing a record-breaking arbitrage spread. In New York, COMEX, silver is at $67.14, but in Shanghai, SGE, silver is trading around the $72 mark. A $5 spread in the commodities market is a massive figure. It creates a vacuum effect. Any silver bar that can be moved is being packed and shipped from London and New York to China. The West is suffering a physical liquidity drain. Why? Because industrial giants like Samsung or Tesla cannot operate production lines using futures contracts. They need real metal. They are executing off-market deals, securing supply directly from the mines, bypassing the COMEX entirely. Furthermore, we are hearing reports of a quiet run on the bank regarding unallocated accounts. For years, banks have sold paper claims on silver they do not fully possess, a fractional reserve system. But now, high-net-worth clients and family offices are demanding conversion to allocated status. They are asking for the serial numbers. They want the bars moved to a segregated shelf. This forces the banks to show their hand. If they don't have the metal, they must go into the open market and buy it immediately to satisfy the client and prevent a default event. This internal squeeze is invisible to the public, but it is the primary driver of the desperation we are seeing. The consequence? The spot price on your screen is slowly becoming a virtual reference. It no longer reflects the true cost to possess the physical metal. Registered inventory, metal that meets delivery standards, is depleting at an alarming rate. We are approaching 0 hour. When the Asian markets open, the most probable scenario is a gap up. The price could open directly at $68.50 or $69, skipping the intermediate levels entirely. However, as professional investors, we must keep a cool head. Extreme volatility always comes with risk. Here is the battle plan for the upcoming session. Patience in the face of a gap up. If the market opens with a massive gap to the upside, do not FOMO. In theory, the price often tends to return to fill the gap, to test demand. Watch the support zone at $67. Beware the shakeout. Understand that the institutions know the retail psychology. They may engineer a sharp, violent drop, a rug pull in the early hours to trigger stop losses and flush out weak hands. Do not mistake a liquidity flush for a trend reversal. Monitor the psychological level of $70. This is not just a round number, it is the last bastion of the bears. If the price decisively breaks $70, the technical model shifts to a parabolic state, vertical appreciation into the price discovery zone. Focus on real assets. In an environment of elevated counterparty risk, holding physical positions is the optimal defensive measure. In conclusion, Friday's closing price of $67.14 is not the destination. It is the siren signaling the collapse of the old price control algorithms. The bank's liquidity nightmare is becoming a historic opportunity for investors who are prepared. I will continue to update you on capital flow developments as soon as the session begins. Thank you for watching. On December 5, 2025, Reuters did something that made all of Wall Street hold its breath. They dropped a bombshell article labeling gold's rally as bubble behavior. Their message was crystal clear. Prices have risen too fast, 60%, the highest performance in 46 years. Sell now before it crashes like it did in 1979. According to conventional logic, when this news hit the wires, combined with rising U.S. Treasury yields, gold should have nosedived. Investors should have panic sold to lock in profits. But the unthinkable happened. Gold didn't crash. It didn't even blink. It swallowed that bad news whole and stubbornly continued moving sideways at all-time highs. This isn't resilience. This is a terrifying anomaly. Why would an asset labeled a bubble by the media and being net sold by ETFs refuse to go down? Has the market gone insane? Or is there a shadow force silently scooping up every single ounce the moment it hits the floor? Welcome to Financial News. Let's rewind the tape and dissect this crime scene. We're going to find out why the old laws of supply and demand are dead. Look at the data Reuters accidentally exposed but didn't explain in depth. They call this a bubble. But bubbles are usually driven by retail mania, the euphoria of the crowd. But look at this chart. Gold holdings in ETFs like SPDR are 10% lower than their 2020 peak. Gold miner stocks are still languishing at the bottom. What does this mean? It means the retail crowd, people like you and me, are not buying. In fact, Wall Street is selling. So the billion-dollar question is, who is buying? And how aggressively are they buying to absorb the selling pressure of the entire Western world? The answer lies in the vaults of central banks. According to Goldman Sachs, these whales have been net buyers of over 1,000 tons of gold annually for the last 3 years. But here is the detail the mainstream media ignores. They aren't buying on the public futures exchange, where you can see the volume. They are operating in the opaque over-the-counter markets in London and Switzerland. This is a stealth operation. By keeping their massive buy orders off the public order books, they prevent the price from exploding too early. They are using iceberg orders, buying massive amounts of physical bars while the public price, determined by paper contracts, stays suppressed. Compare this to the China silver dump. When the London market ran out of silver, China had to flush their stockpiles to save the price. But with gold in 2025, the situation is the exact opposite. The West is trying to suppress the price using news and derivatives, paper gold, but the East, China, Russia, India, is standing underneath, catching every single bar of physical metal. This is a reverse squeeze. On the COMEX, for every 1 ounce of registered physical gold, there are now hundreds of paper claims trading against it. It is a game of musical chairs played with dynamite. When the music stops, there won't be enough chairs. They are draining the physical liquidity. Reuters calls it a paradigm shift, but the accurate term is the depletion of Western inventory.
Why are they hoarding so frantically? Why don't they trust the dollar anymore? Let's look at the death spiral mechanism that the article only cautiously hinted at. Reuters compares 2025 to 1979, but this comparison is mathematically flawed. Phase 1, 1979, U.S. debt was only 30% of GDP. Paul Volcker could raise rates to 20% to kill inflation and save the dollar. Phase 2, 2025, U.S. debt is 4 times higher than in 1979. Budget deficits are running at 6% of GDP annually. Here is the deadly trap. If the Fed raises rates to stop gold, the U.S. government goes bankrupt because it can't pay the interest. If the Fed cuts rates to save the government, inflation explodes and gold goes to Mars. This is no longer just about economics. It is geopolitical warfare. Daniel Oliver from Myrmikan Capital pointed out the exact moment the system broke, the 2022 seizing of Russian reserves. When the U.S. weaponized the dollar, they sent a signal to every sovereign nation: your savings are only yours if we agree with your politics. That shattered the trust that took 80 years to build. You can't print trust. Once it's broken, the flight to safety becomes a permanent migration, not a temporary trade. The Fed's balance sheet is bleeding because it's stuffed with long-term bonds that have lost massive value. Their gold coverage ratio is now only 16% of their liabilities. Think about that. The entity issuing the world's reserve currency is technically insolvent on a mark-to-market basis. Do you see the parallel with the silver market? In silver, it was a physical shortage due to industrial demand, solar. In gold, it is a shortage of trust due to fiscal collapse. The U.S. cannot print more gold. They can only print more dollars. And the central banks know this. They are exchanging paper that is about to lose value for the only real asset left. They aren't buying for profit. They are buying for survival.
So, what is the next scenario? Look at the math, because math doesn't lie. Currently, the gold price is rising solely due to smart money, the whale, buying pressure. The crowd, the retail, hasn't even joined yet because they believe articles like Reuters claiming this is a bubble. And here is the psychological trap. The article wants you to look at the nominal price, $3,000, $3,500, and think it's expensive. But priced in purchasing power, priced in gallons of oil, priced in hours of labor, gold is still cheap. The bubble is in the currency you're holding, not the metal you're watching.
But what happens when Western inventory runs dry? Just like silver, when the vaults in London are empty, price will no longer follow any technical analysis. When individual investors realize bonds are no longer safe and stocks are too risky, they will stampede into gold. But at that moment, who will sell to you? The central banks? No, they're buying. The ETFs? They've been net selling for 3 years. Their vaults are emptying. We're facing a supply shock on a global scale. Reuters calls it a paradigm shift. I call it a repricing. Gold isn't rising. The value of currency is free falling to its true value, 0. Don't let the headlines fool you. They scream bubble to shake the tree, to scare you into selling the little gold you have left. Don't sell your insurance when the world's financial house is on fire. The physical supply shortage is about to be exposed. I am monitoring the inventory data at COMEX and LBMA closely. There are signs that we are scraping the bottom of the barrel. If you want to receive an early warning alert when the physical squeeze signal officially triggers, comment "Gold Squeeze" below. Remember, in this game, you cannot use policy to fight math, and the math is on gold's side.